Trump pressures Intel to sell its stake. Tech stocks plunge. Friends, have you noticed that the volatility in your accounts has surged recently, with some positions even plunging for no apparent reason? Are some of you lying awake at night, filled with anxiety? And the market seemed calm at first, yet in just one night, the tide completely reversed. Tech stocks led the plunge. Entire sectors were brutally wiped out. Within just a few hours, companies like Nvidia and Plunge, once hailed as myths, saw their market value evaporate by hundreds of billions of dollars. But names that once symbolized the future were ruthlessly abandoned by the market yesterday. Many investors are still struggling to recover from the shock. Friends, this is by no means an ordinary correction. It is more like a loud wake-up call. The tide is turning, and at the same time, a highly unusual phenomenon emerged in the market. The so-called boring sectors, and utilities, and real estate were rising against the trend. Imagine this, while star stocks were being battered, in traditional sectors like supermarkets, gas, electricity, and housing rents were steadily climbing. It was as if, in a stage play, the lead actor suddenly stumbled, while the supporting actors unexpectedly took. You might be wondering, what force has shaken the market like this? Did the Federal Reserve suddenly turn hawkish? Did inflation data spike again? Or was it a sudden shift in the international political landscape? None of the above. The real trigger turned out to be a research report from academia, not an analysis from a Wall Street investment bank, nor a short seller's bearish call, but rather from Massachusetts Institute of Technology, MIT. Then friends, I'm a professional investor who has focused on U.S. stocks for over a decade. Can you believe it? A single academic report managed to wipe out trillions of dollars in market value from Wall Street in just one day. What exactly did it say that sparked such sudden panic across the entire market? Yesterday's U.S. trading session was truly a tale of two extremes. Those clinging stubbornly to hype and concepts stared at their accounts in sleepless anxiety, while those who had already diversified and prepared actually breathed a sigh of relief amid the spin. But friends, the ups and downs are only the surface. What truly deserves our attention is that the market has quietly arrived at a critical turning point. Whether you can recognize this shift will directly determine whether your investments in the coming months or even the whole year end up as profit being harvested. Today's video is especially important. Before we begin, I'd like to ask you to share your thoughts in the comments. And if you find my content valuable, feel free to subscribe. It's free. Your support is what motivates me to keep delivering in-depth analysis. At the end of this video, I'll provide clear action strategies to help you find opportunities in this wave of market volatility, rather than becoming the last one left holding the bag. So why did this seemingly neutral academic report trigger such massive shockwaves across the market? The reason is simple: it pierced the biggest illusion of the past 2 years. The report revealed a stunning fact. As many as 95% of companies have gained absolutely no financial return from their investments in artificial intelligence. That's right, you heard me correctly. Not 50%, not 70%, but 95%. In other words, almost all the money companies have poured into AI has gone down the drain so far. Coincidentally, just a few days ago, OpenAI CEO Sam Altman also publicly warned investors are overly excited, and inevitably, some will end up losing everything in this frenzy. Imagine these two forces colliding. On one side, MIT's cold, hard data showing that 95% of companies haven't made a dime. On the other, one of the industry's most authoritative voices openly admitting that a bubble may truly exist. This is the market's double blow. As a result, we saw massive capital outflows from the tech sector, while defensive sectors unexpectedly staged a comeback. This raises an even more serious question. If earnings truly can support it, can the core logic behind the U.S. stock market's rally over the past 2 years still hold up? And if even the most sought after, the 7 tech giants are starting to be questioned by the market, the future of U.S. stocks may be far more perilous than anyone imagined. This downturn may look like mere price fluctuations on the surface, but in essence, it is a crisis of confidence. Turning point. Over the past 2 years, there has been only one true market myth. NVIDIA's chips were in overwhelming demand. Microsoft and Google's ecosystems seemed to be thriving. And Palantir spun limitless imagination out of government and defense contracts. Then, as long as you've stuffed a few buzzwords into a PowerPoint, the market was willing to hand you the valuation of the next 3 years in advance. But yesterday's reversal showed that this blind faith is collapsing.
Why?
Because the market is starting to feel fear. Fear that stories could turn into disasters. Fear that the bubble could burst. In the past, investors asked, how much profit can it bring? Now, they're asking, what if it doesn't make any money at all? That's a fundamental shift. When investors move from imagining the future to questioning the present, the entire valuation system begins to shake. And the comeback of defensive sectors is, in fact, a psychological projection. In industries like supermarkets, utilities, and real estate may not have glamorous stories, but they do have cash flow, dividends, and visible, tangible profitability. The market seems to be saying, rather than betting on an uncertain future, it's better to hold tightly to the certainty of the present. So, in yesterday's sell-off, the truly frightening part wasn't the number sit, was the sentiment. Once confidence collapses, the market enters a highly sensitive state where any slight disturbance could trigger chain reaction. If you found this analysis valuable, please give it a like, subscribe to the channel, and share your thoughts in the comments. Do you believe this is truly the future, or just another bubble? Your engagement is the biggest motivation for me to keep bringing you in-depth analysis. MIT's groundbreaking study, The Generative Chasm's State of Business 2025, released on Monday, revealed that 95% of companies have seen no returns on their investments in generative AI. With only 5% of projects generating revenue based on executive interviews, employee surveys, and case studies. The report concludes that the issue lies not with the models themselves, but with companies' lack of process transformation and strategic planning. Investment is turned into a money-burning game. Wall Street's core concern is whether AI can be monetized, and this report undoubtedly poured cold water on that. However, MIT also emphasized that the few successful cases prove AI still holds commercial potential. These success stories are often not the giants we usually imagine, but rather agile startups or even mid-sized companies with a focused business. The report identified a common pattern. Instead of chasing bread, they zero in on a single pain point and strive to do it perfectly. So, the biggest takeaway from this report for us as investors is this. Profitability doesn't depend on the model, but on execution. Success doesn't come from size, but from focus. If you found today's content helpful, don't forget to like and subscribe and share your thoughts in the comments. What's your view on MIT's report? Do you see it as long-term value or just another capital bubble? Over the past 2 years, some young startups have focused on back-office automation scenarios, such as claims processing, from financial report generation, customer service, Q&A, and ticket routing. These applications have clear rules, structured data, and measurable ROI, allowing many companies to grow from zero to tens of millions in revenue within a year by genuinely helping clients cut costs and improve efficiency. In contrast, most enterprises have spent large budgets on marketing copy, presentations, and social media content. Been efforts that have almost no impact on the income statement. The MIT report pointed out that the real goldmine lies in back-office automation, especially in replacing BPO and cutting external costs. Ironically, this is also the least invested direction. Another key difference is by vs.build. The success rate of purchasing specialized tools is about 67%, while building in-house is only 1%, since the former provides immediate access to mature products and the advantage of continuous iteration. And what about building in-house? It may sound unique, but companies must shoulder the full costs of computing power, maintenance, compliance, security, and auditing. Many large firms ambitiously set out to create their own platforms, only to find that no one uses them after launch. Prod models fall behind on updates, and they end up as massive sunk costs. There's another key point. Who drives the project? And successful companies often hand the initiative to frontline managers because they know exactly where processes get stuck and where costs can be saved immediately. Failed companies, on the other hand, rely on central labs building behind closed doors, resulting in tools full of limitations that business units can't actually use. As the MIT report bluntly puts it, the problem is not the technology, but the organization's ability to execute. So what does this mean for the capital markets? The answer is simple. Not all AI companies deserve high valuations. Only those that focus on real pain points and deliver ROI quickly will be the true winners of the future. Those relying on flashy presentations and burning money on in-house projects will only be abandoned by the market. Faster so when investors finished reading this report. Their first reaction was, have we been giving too many companies the wrong valuations over the past 2 years? MIT's report, ESA, bucket of cold water. And the Ottoman incident was like pouring fire straight into a barrel of oil. If you also believe the capital markets are standing at a major AI crossroads, please give this video a like, subscribe to the channel, and share in the comments who do you think will be the biggest winners over the next 3 years. The back-office automation, players who can quickly deliver ROI, or the PPT storytellers who keep selling a vision. Just a few days before this report was released, OpenAI's Sam Altman openly admitted that he believed some investors could lose a lot of money. He also stressed that the market's enthusiasm for AI has become excessive and is very likely entering an irrational exuberance stage. Just think about it, what a heavyweight signal. This is .MIT. As an academic authority, uses data to tell you that 95% of AI companies haven't actually made money. Altman, as an industry authority, uses his position to warn that investors may truly lose big when this 1-2 punch lands. Even the most loyal believers and largest shareholders can't help but start wavering. What's worse is that the market backdrop is already an environment of extreme valuations. According to Bloomberg data, the forward PE ratio of the Nasdaq 100 stands at 27 times fully, one-third higher than its historical average. Nvidia's forward PE is near 40, Microsoft's is around 35, and both Meta and Google trade above 25. By comparison, the average for the entire S&P 500 is only 21. The reason the market was once willing to grant these companies such lofty premiums was the belief that they would quickly turn profits. But now, with MIT's report showing that most companies haven't made money, and Altman stepping forward to warn that a bubble may truly exist. What justification do investors have left to support these sky-high valuations? The crux is this: the issue is no longer just about technology. It strikes directly at what Wall Street cares about most: income statements. Most of the past doubts centered on flaws in the models, excessive energy consumption, or insufficient computing power. But for Wall Street, none of these were fatal. However, when the data and financial statements are laid out in front of everyone, the market can no longer pretend not to see them. Why? Because what the capital markets have always cared about is not whether the technology is perfect, but whether it can truly make money, even if there are technical shortcomings. As long as future profitability can be delivered, investors are still willing to pay. But this time, MIT's research report is different. It uses cold hard data to tell us. Companies may have poured money into AI, but they've made almost nothing in return. 95% of pilot projects have generated no financial return, with only 5% actually bringing in revenue. This report skips past the technical aspects and speculative hype and goes straight to the core question investors care about most. Can AI truly make money? Shifted from euphoria to panic, because once the debate shifts from a technology issue to a profitability issue, investors will immediately re-examine what has really been propping up the lofty valuations that were pulled forward over the past 2 years. As soon as the MIT report came out, the market reaction was almost chain-like. Leading AI stocks such as Nvidia and Palantir became the hardest hit in the selling then. Tech giants like Microsoft and Google also came under pressure. Even high-flying stocks with little direct connection to AI were dragged down. Finally, capital flowed out of growth stocks and rotated into safe havens such as consumer staples, utilities, and real estate. So, this downturn isn't just about a few tech stocks. It has sent a broader signal. The market is shifting from story-driven high growth to a preference for reliable cash flow. The real fear isn't falling stock prices, but the reversal of the valuation logic itself. Over the past 2 years, why was Wall Street willing to give Nvidia a pay of 40, Microsoft 35, and Meta and Google valuations north of 25? There was only one reason: because everyone believed AI would quickly translate into profits. And the growth expected over the next 3 to 5 years had already been priced into today's valuations. But as the halo fades, the market immediately looks for a new footing. Yesterday's trading made it clear: capital is pulling out of tech and flowing into defensive sectors like consumer staples, utilities, and real estate. In times of uncertainty, stable cash flows and dividends feel far more reassuring than castles in the air. And the point isn't just defense. Remember regime. The indicator already shows it. The market is shifting from AI frenzy to recession concerns. If you found this analysis helpful, please give it a like. It really means a lot for the channel. Don't forget to subscribe and turn on the notification bell so you'll be the first to get my latest in-depth market insights. And I'd love to hear from you in the comments. Do you think AI can still deliver real profits? Or has the valuation already been priced in ahead of time? If you enjoy this kind of deep dive breakdown, please support the channel with a like and a free subscription so you won't miss my latest tracking and analysis on u.s.tech. Small and mid-cap stocks are entering an opportunity phase, but risks remain. The big names have already risen too much in the early rally, leaving them with high risk. Defensive sectors, including consumer staples, utilities, and real estate, can help stabilize the base of a portfolio. And small and mid-cap stocks have strong recovery potential, with a focus on selecting companies that generate profits and cash flow. Positions should be diversified, balancing offense and defense. The key lies in how Todd discerns real opportunities lie in genuinely undervalued stocks, not in value traps. Don't place all your bets on the giants there. Earlier surges have already priced in much of the upside, leaving higher risks ahead. Instead, increase exposure to defensive sectors like consumer staples, utilities, and real estate, where stable cash flow and dividends can anchor your portfolio. At the same time, pay attention to the recovery of small and mid-cap stocks. Historically, winners in recovery cycles often emerge from undervalued small caps. Then focus on companies with solid earnings and strong cash flow. Maintain both flexibility and balance, diversify your positions, blending defense with offense. But here's the real challenge. With thousands of small and mid-cap companies, dozens of defensive sectors, and countless sub-industries, how do we actually make the right picks? Which ones are truly undervalued, waiting for a rebound, and which are merely cheap on the surface, masking themselves as value while hiding as traps? I know many of you are feeling anxious during this market shift. When the market feels on edge, it's not easy to stay calm, focused, and committed to deep stock research. But don't worry, I've already done the work for you. I've carefully put together a list of defensive stocks suited to the current environment, along with small and mid-cap companies most likely to benefit first when market trends shift. And to get the list, simply click the pinned link in the comments and send today's keyword, MIT report. If you've already received the previous list, there's no need to click again. Just send me the new code word to support me. Please remember, the more tense the market becomes, the more we need to stay steady. Start with the big picture. Research the right companies, control your position size before entering it, and keep in mind that making money in U.S. stocks has never been a dream, but it has never been easy either. I firmly believe today's watch list can help you avoid this period of volatility. If you find this helpful, don't forget to like this video, hit the subscribe button, and leave a comment. Your support truly helps me keep creating more content like this for you. Finally, I'd love to hear your thoughts. Do you think this pullback is just a short-term emotional overreaction, or the beginning of a real bubble bursting? Who do you think will be the biggest winners in the second half of the year? Defensive stocks or small and mid-cap stocks? Let's discuss in the comments.